Hello students, hope you all are preparing well for your exams. In this video, I would be discussing May 2026 income tax question paper. It was considered to be one of the challenging and lengthiest paper by the students. Even I felt the same because it has really some good adjustments and also here and there some minor mistakes are there which I would be highlighting in this video. So if you are a student who is preparing for September 2026 or even Jan 2027 exam, then do watch this video fully because I would be discussing each and every question and answer in detail and I will also be giving lot of insights. So let us begin the discussion with the multiple choice questions, guys. So the first one is case scenario based MCQ. So first we will go and read the requirement of the question and then we will read the case, guys. Based on the facts of the case scenario given above, choose the most appropriate answer to the following question. That is MCQ 1 to 3. So what is it? We will see one by one. Compute the amount of net worth of unit A for the purpose of slum sale for the assessment year 26-27. Okay, question is on section 50B in capital gains chapter. Second one, compute the amount of capital gain or loss arising from the slum sale of unit A for assessment year 26-27. So both is on section 50B, guys. Then compute the amount of tax deductible at source by Mr. Jayesh for assessment year 26-27 on the amounts paid to Mr. Naresh. So the question is on TDS. Okay. So there are three questions. So now we understood what we are supposed to do. Now we will go and read the case, guys. So this would be the better approach to solve case scenario based MCQ. Mr. Jayesh, a resident individual aged 45 years. So age is 45 years less than 60. So it will not have any impact on our answer, guys. Is a proprietor of Jayesh Enterprises having two units, Unit A and Unit B. The total sales of Jayesh Enterprises for the previous three financial years, that is last three financial year, were 12 crores for 25-26, 25 crores for 24-25 and 22 crores for 23-24. He transferred Unit A to Rose Limited by way of slum sale on 12th January 2026. That is during our previous year. Okay, our previous year it's 25-26, which was set up in October 2012. Guys, what was set up in 2012 has been sold in 2026. So can I consider the holding period is more than 36 months? Yes. As per section 50B, that is slum sale, when the entire undertaking has been sold without assigning the values to the individual assets, the undertaking itself will be considered as a capital asset. And if it is held for more than 36 months, then it is considered to be a long term. If not, short term. Please be careful. The period of holding as on today is only 12 months and 24 months. But in case of slum sale, still 36 months is there. Yes, sir. So as it is more than 36 months, the time gap between the date of setting up this and selling it, can I consider it as long-term capital asset? Yes, guys. So I will just write it here, long-term capital asset. That means we are supposed to calculate long-term capital gain. Long-term capital gain. Yes, sir. Next, Mr. Jayesh paid professional fee and commission in connection with this transfer, amounting to 20,000 and 35,000 respectively to Mr. Naresh, a resident individual. So Naresh is a payee. There is one question on this, guys, this part. If you just read this part, you will be able to answer that MCQ. So Jayesh is an individual. Yes, sir. Paid professional fee and commission in connection with this transfer amounting to. So it is nothing but expenses on transfer. So while calculating the capital gains from full value of sale consideration, should we deduct expenses on transfer? Yes. So totally it is coming to 55,000. We need to deduct it. We will get net sale consideration. Okay. That part is different. But let us discuss from TDS point of view. So 20,000 is professional fee and 35,000 is commission. Come on, guys. So for 20,000 which is paid as professional fees, we need to check which section, 194J. But under section 194J, the threshold limit is 50,000. But here it is 20,000. So no TDS. No TDS. Yes, sir. Then coming to 35,000, which is commission. So for commission, we need to check which section, 194H. Under section 194H, what is the threshold limit? 20,000. 20,000, right? Yes. So it is an amendment. Please be careful. So it is 20,000. So as 35,000 is more than 20,000. Should we deduct TDS? Yes. At what rate? 2%. 2% of 35,000, which come to 700. Yes, sir. But one more important thing, guys. The payer is Jayesh. Correct? Individual. Yes. Both section 194J and H will not cover the payer who is an individual or HUF who was not subject to tax audit last year. Correct? I repeat. Both section 194J as well as 194H covers the payer, any person other than individual or HUF who was not subject to tax audit last year. In simple, if payer is an individual or HUF who was not subject to tax audit last year, then they need not deduct TDS under both the sections, irrespective of the amount. But here you check. Jayesh is a payer who is an individual, but what was his turnover in the last financial year? It was 12 crores. So is he subject to tax audit last year? Yes. So is he covered under payer for both the section 194J as well as H? Yes, he is covered under payer, guys, because he was subject to tax audit last year. Okay, sir. But anyway, under section 194J, there is no TDS because the amount paid is less than the threshold limit of 50,000. Whereas under section 194H, yes, on 35,000, 2% TDS has to be deducted. Okay, fine. Next, the balance sheet of Jayesh Enterprises as on that date is given below. One by one we will see. First, asset side, land 2,500 at revalued figure, unit A 40%. It is revalued itself, so that is the thing which we need to consider. Then plant and machinery 2,500 at WDV, unit A 40%. Sundry debtors 600, unit A 25%. Then closing stock, unit A, sorry, total is 833.33, unit A is 40%. Then other assets 800, unit A is 40%. Okay. Guys, you should know one thing. Whenever we are calculating the net worth, why do we need a net worth, sir? Guys, when there is a slum sale, the cost of acquisition is nothing but the net worth of the undertaking as on the date of transfer. As on the date of transfer. Correct? Yes. So, while calculating the net worth of the undertaking, we need to do asset minus liability. And asset should always be at what value? Book value. Book value. Correct. So if any asset is revalued, we need to ignore the revaluation part. We need to ignore the revaluation part. So this figure is revalued figure. So if anything is given, what is the revalued figure and all, we will try to consider it. We need to deduct it. Yes. Okay. Then coming to the liability side, owner capital 4,100, accumulated balance in P&L account 1,333.33. Then revaluation reserve created due to upward revaluation of land 500. So should we deduct this from 2,500? Yes, guys. So what would be the book value? 2,500 minus 500, 2,000. Hope you understood. For the purpose of calculating the net worth, we need to ignore the revaluation, people. Please be careful. Yes, sir. Next, bank loan is 600. How much belongs to unit A? 60%. Then sundry creditors 700. How much belongs to unit A? Only 20%. Only 20%. Calculation part I will explain later. First, we will finish reading the information. Other information, slum sale consideration on transfer of unit A was 1,600 lakhs. Fair market value of the unit A on 12th January 2026, that is the date of transfer, is 1,750 lakhs. Okay, guys, what should we take? We consider this as FMV1 or FMV2. We need to take whichever is higher. Whichever is higher, 1,750 lakhs. 1,750 lakhs. I will just show you once. Okay, you guys would have already studied this in capital gains chapter under section 50B. So if you also have the material, you can just come to that section 50B in capital gains chapter. Just a minute, I will also open in my provision book. Yes. So you can see in case of the slum sale, guys, I have given the format here. We need to take full value of sale consideration. Sir, what is full value of sale consideration? Either of FMV1 or FMV2. Sir, what is FMV1? What is FMV2? I have mentioned here. FMV1 being the fair market value of the capital assets transferred by way of slum sale. Okay. Then FMV2 being the fair market value of the consideration, that is either in monetary received or accruing as a result of transfer. Is that clear? Yes. So we are supposed to take how much? 1,600 or 1,750, whichever is higher, 1,750. And from this, we need to reduce the expenses on transfer, which in our case is 55,000. Okay, then we will get net sale consideration. From that, we need to reduce cost of acquisition, which is nothing but net worth on the date of transfer. And what is net worth, sir? Net worth means aggregate value of the assets minus value of liabilities. And if there is any revaluation, we need to ignore it while calculating net worth. And here, while taking the value of the assets, we need to consider only the book value. And book value with respect to the assets is, I am mentioned here. Especially if it is a depreciable assets, we need to take written down value. And if it is a self-generated goodwill, nil. Sir, what if it is a purchased goodwill? You will take whatever is the cost. You will take whatever is the cost. Yes, sir. And if there is any capital asset for which already 100% deduction is claimed, we need to consider it as nil. For any other asset, book value. Yes, sir. Chal. Land was purchased on April 10th, 2012 at 1200 lakhs. Yes, guys, listen here. This is considered to be historical cost. Correct? Huh? This is historical cost. But in the balance sheet, you can see land is shown at 2500. And if I remove revaluation effect of 500 also, still 2000 is there. So then what is the difference 800? We are not sure. We are not sure about it. Clear? Yes. And asset actually should be shown in the balance sheet, especially land, which is a non-depreciable asset, should be shown at historical cost. That is considered to be a book value. But here, okay, there is a revaluation of 500. If I remove that also, still 2000 is there. So there is a conflict here, guys. Should we take 2000 or should we take actual cost 1200? So I guess there is some mistake here. So better to ignore this point. Better to ignore this point, guys. Is that clear? So you can consider 2000 as book value. Next, no individual value of any asset is considered in the transfer deed because it is a slump sale. Then other assets of unit A include goodwill acquired and put to use on September 1st, 2024 for 200 lakhs on which no depreciation has been charged. Remaining amount of other asset represent cash and bank balance. Okay. Guys, other assets includes goodwill, it seems. Okay. Goodwill was purchased, not self-generated, but last year, on which no depreciation is claimed, it seems. Sir, fair enough. Because on goodwill, even if it is purchased, no depreciation as per section 32. Guys, actually on intangible assets, depreciation is allowed at 25%. But on goodwill, even though it is intangible assets, no depreciation. No depreciation. That means whatever value is appearing in the balance sheet, is it a right value? Yes. I will just show you. One second. You can come to PGBP. Section 32. Depreciation rates is there. No, you can come there. Yeah. You can see, oh, what is the depreciation rate for intangible assets like know-how, patent, copyright and all? 25%. But I have clearly mentioned here, no depreciation will be allowed on goodwill. Even if it is a purchased goodwill, you cannot claim depreciation on it. So that means whatever value is given in the balance sheet, 200 lakhs, is it right? Yes. If it was any other asset for which depreciation is not reduced, then I would have taken this, reduced depreciation, calculated WDV, and I would have considered that in the net worth calculation. But here, I need not do any extra adjustment, guys. Yes. So please be careful with it. Okay, sir. Based on the facts of the case scenario given above, choose the appropriate answer. First one, net worth of unit A. Net worth, we need to calculate the value of each individual assets for unit A, guys. Yes. Just a minute. Yeah, one by one. First, land 2500. From that, revaluation part you remove. Remaining is 2000. Into, what is the share of unit A? 40%. Take 40%. Got it? Please be careful. Don't do 2500 into 40% and then deduct 500 and all. That would be wrong. That would be mistake. Yes. So land share of unit A is for 800, guys. Yes. Then coming to plant and machinery, 2500 into 40%, 1000. Then for sundry debtors, 600 into 25%, 150. Then closing stock, 833.33 into 40%, 333.33. Then other assets, 800 into 40%, 320. Yes. So the aggregate value of the assets is 2603.33. Then coming to liabilities, straight away go to liabilities. Bank loan 600 into 60%, 360. Then sundry creditors 700 into 20%, which comes to 140. So add up both 500. So do assets minus liabilities. You will get 2103.33. Yes, sir. Choose the answer. B. 2103.33. Yes, sir. Okay. Next, second requirement is compute the capital gains. And it is long term, guys, as it is held for more than 36 months, long term. So let us calculate. Net worth is already ready. Full value of sale consideration, I already told you. It comes to 1750 lakhs. Yes, sir. So 1750 lakh is nothing but full value of sale consideration, people. Full value of sale consideration. Then expenses on transfer is like 20,000 and 35,000. Yes, expenses on transfer. Then the cost of acquisition, which is nothing but net worth, which we have calculated here. Reduce it. So you will get long-term capital loss of 353.88 lakhs. 353.88 lakhs, guys. 353.88 it is. Okay. Yeah. Okay, sir. So here in the answer, none of the option is correct. None of the option is correct. Please be careful. Short term loss is there, but in our given case, it is a long term, not short term. Please be careful. Yes, sir. So even ICAI, just a minute, we will see what suggested answer they have given. None of the option is correct actually. Yeah, for second one, no correct option. And as per their suggested answer, they have given 353.33 lakhs. 353.33 lakhs, but actually, it should be this much. Where did I calculate? Just a minute. Yes, 88. Got it. Maybe they have not considered this as expenses on transfer, but guys, anything paid at the time of transfer should be claimed as expenses on transfer. So should we deduct this, sir? Yes. So please be careful with it. So you can just mark this. Okay, sir. Fine. Next, the third one, TDS. TDS part I already explained. Under section 194J, no TDS, whereas under section 194H, 2%. So 2% on 35,000 comes to 700. So the answer would be 700. C. Got it, people? Yes. Chalo. We'll move forward. Second case scenario. Based on the facts of the case scenario given above, choose the most appropriate answer for the following question from MCQ 4 to 7. Okay. First one. In whose hands the rental income will be taxed? That is Vijay, Rashmi or Anushka. Okay. This is about rental income, house property. Next, assume that the property was gifted by Vijay to Banu, his major son, instead of his wife Rashmi, in whose hands the rental income will be taxed, Vijay or Banu. Banu let out the property to Prabhas on 1st May 2025 for a monthly rent of 54,000. Okay. So in whose hands it is taxable is the thing which we need to decide. The rental income. Okay. Next. Sixth one. What shall be the amount of deduction available to Vijay in respect of contribution to pension scheme? That is 80CCD deduction, guys. Okay. Amount of deduction available to Vijay. Under which section? 80CCD. 80CCD. Okay, sir. Next, seventh one. Examine the applicability of advance tax provision in the hands of Rashmi, assuming that she does not have any other income chargeable to tax, ignoring the income from house property gifted by her to her family as mentioned above. Means we need to ignore that house property thing. Okay. So applicability of advance tax they are asking. Fine. Chal. We'll quickly go and read the case now. Vijay, a resident individual aged 57 years, less than 60, is employed with a private sector Indian company. His basic salary was 1,20,000 per month. Basic salary. During financial year 25-26, both Vijay and his employer contribute 15% of basic salary to the pension scheme referred to in section 80 CCD notified by the central government. Both of them are contributing 15% of basic salary. He has only basic salary, nothing else. Okay. So this is with respect to income from salary, guys. Okay, sir. Next, Vijay gifted a house property valued 51 lakh to his wife. Rashmi on 1st April 2025. Guys, here husband gifting house property without consideration. So gift means obviously consideration is not there to a spouse. Then deemed ownership is applicable. Deemed ownership under section 27 is applicable, guys. Deemed ownership under section 27. Yes, who is considered to be the owner? Vijay. On the same day, Rashmi gifted the same to her daughter-in-law, Anushka. Okay, from Rashmi it is passing on to Anushka. Anushka let out the house for a monthly rent of 54,000 to Prabhas on 1st May 2025. Please be careful from 1st May. April no rental income. All of these associates did not opt out of default tax regime for assessment year 26-27. Okay, guys, interesting story. This is about gifting. This is about gifting the house property. Listen here, people. Interesting story. Now, Vijay gifted the house property to Rashmi. Who is a spouse. In that case, who is considered to be the deemed owner? Vijay. So if Rashmi derives any income from this house property, it will be taxable in the hands of whom? Vijay, as per section deemed ownership. Okay, this is deemed ownership under section 27. Okay, sir. It would be taxable in the hands of Vijay, who is the transferor. This is as per section 27, guys, in income from house property. Okay. Now, what Rashmi is doing is she is giving it as a gift to daughter-in-law. Daughter-in-law. So, if daughter-in-law receives any income from this house property, it will be clubbed with whom? Rashmi. As per section 64 subsection 1, if any asset is given or transferred without consideration to daughter-in-law, whatever income the daughter-in-law will derive from that asset will be clubbed with the transfer. That is in this case mother-in-law. So it is going reverse, guys. Whatever daughter-in-law will earn from the property will be clubbed with Rashmi. And whatever Rashmi will earn will be taxable in the hands of whom? Vijay. So ultimately the house property income will be taxable in the hands of Vijay, guys. In the hands of Vijay. Vijay will have income from house property. Hope you guys are getting it. Clear? First we need to calculate for daughter-in-law what is the income. That will be clubbed with Rashmi. But is it taxable in the hands of Rashmi? No. It will be taxable in the hands of transferor. Who is Vijay? Hope you guys got it. Yes. Next, coming to second part, next paragraph. Rashmi is the chartered accountant having a gross receipts from profession amounting to 45 lakhs. For the financial year 25-26, she opted for the provisions of section 44 ADA. Is she eligible first of all? Yes. Gross receipt is less than 50 lakh. Even there is a higher limit of 75 lakh also, but we need not worry about 75 lakh because anyway, it is less than 50 lakh here. She fulfilled all the conditions prescribed to opt for the presumptive taxation. So in that case, what will be her income, guys? Into 50% straight away. Gross receipts into 50% is the presumptive income. Okay. Based on the facts of the case scenario given above, choose the most appropriate answer to the following question. MCQ 4 to 7. Okay. In whose hands the rental income will be taxed and how much? They have also asked with respect to how much also. It will be taxable in the hands of Vijay. We already decided that. Yes, but how much? Guys, please be careful. The property was let out by daughter-in-law Anushka from 1st May. So you need to consider only 11 months. That is from 1st May to 31st March. That is the end of our previous year. Hope you got it. 11 months. So 54,000 into 11 months will be our GAV. And even if question is silent, please provide for standard deduction. Please provide for it. Standard deduction 30%. Sir, what about municipal tax, interest on loan? Question is silent, so we will ignore it. So what is the income from house property, guys? 4,15,800. Taxable in the hands of Vijay. Vijay, where are you? Yes. Sure. Fine. Shall be taxable. One by one I will read. First one, 4,15,800 shall be taxable in the hands of Vijay and nothing shall be taxable in the hands of Rashmi and Anushka. Yeah, that is the right answer, guys. But let me read the other option also once. 4,15,800 shall be taxable in the hands of Anushka. No. 4,15,800 shall be taxable in the hands of Rashmi and nothing shall be taxable in the hands of Vijay. No, that is also not right. 4,15,800 shall be taxable either in the hands of Vijay or Rashmi. No, no such option. Whose total income before clubbing is this rental income is higher. No guys, nothing like that. Chalo. Fine. We'll move on to question number 5. Assume the property was gifted by Vijay to Banu, his major son, instead of his wife Rashmi, in whose hands the rental income will be taxed. Okay, assume the property was gifted by Vijay to Banu, major son. Guys, if it is for a major son, deemed ownership also is not applicable. Clubbing is also not applicable. Because as per section 27, which is a part of income from house property, the deemed ownership is applicable only if house property is transferred by the assessee to the spouse or minor child without consideration. Spouse or minor child. Here it is major. So section 27 is not applicable. Then even in clubbing, as per section 64 1A guys, 64 1A, income of a minor child is clubbed with the parent. That is either father or mother, whoever is having higher income before clubbing. But here the son is major. So 64 1A also is not applicable. Correct? Yes. So in this case, the income will be taxable in the hands of whom? The person who is earning it, not Vijay. Okay. Let me read it quickly. Assume the property was gifted by Vijay to Banu, his major son, instead of his wife Rashmi, in whose hands the rental income will be taxed, Vijay or Banu. Banu let out the property to Prabhas on 1st May, same date, for a monthly rent of 54,000. Same to same amount, guys. See, it need not be same always, but in this question it is same. So amount would be same only. 4,15,800, but taxable in the hands of Banu, not Vijay. Yes. We'll read the option. 4,15,800 shall be taxable in the hands of Vijay and nothing shall be taxable in the hands of Banu. No, wrong. B. 4,15,800 shall be taxable in the hands of Banu and nothing shall be taxable in the hands of Vijay. Yes, right. Yes, this is right. Next, C. 4,15,800 shall be taxable 50-50, nothing. 4,15,800 shall be taxable either in the hands of Vijay or Banu. No, guys. So the answer is B. Option B. Next. Next. Before reading it, 1 second. This one sentence is there here. All this assessee did not opt out of default tax regime. Means they are following default scheme, guys. Please be careful. All the assessees, whoever's name is given here, including Vijay, they are following which scheme? Default scheme. Yes. Because for this point it is relevant. What shall be the amount of deduction available to Vijay in respect of contribution to pension scheme? Guys, for pension scheme, the deduction is available under section 80 CCD, but only employer contribution is allowed under default regime. Sir, what about Vijay? He is also contributing. Yes, he is contributing, but there is no deduction. If Vijay was following optional scheme, then for both his contribution as well as the employer contribution, you would have claimed the deduction under section 80 CCD. But here, as he is following default scheme, he can claim deduction only for employer contribution. Sir, how much? 14% of salary, guys. See, if Vijay, and Vijay is not a government employee, please be careful, just a minute. Vijay is not a government employee. Then you told, sir, 14%. Yes, for government employees, it is 14%. For other than government employees, if they are following default regime, then it is 14%. If they are not following default regime, it is 10%. Let me show you. Let me show you. Just a minute. You can come to deduction chapter quickly. ATCCD. Hello, ATCCD. Come on. Open it quickly. Tuck, 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 tuck. Yeah. You can see here. So employee contribution is allowed as deduction under section 80 CCD subsection 1 and 1B. That is not available in this case as assessee is following default regime. So let us forget about it. Employer contribution. If it is a contribution by central government or state government, it is 14% of salary. But in our case, Vijay is not a government employee. That is also ruled out. Then contribution by any other employer to NPS, it is 10% of salary. But 14% if the employee is following default scheme under section 115 BAC, guys. So in our case, it would be 14%. Hope you got it. Yes. So 14% of 1,20,000 into 12. 1,20,000 is the basic salary per month into 12 months into 14%. Please be careful. Only rent is from May. Salary is for the entire year. Yeah, take it into 12 months. So it gives us 2,01,600. Sir, is it restricted to 1,50,000? No, please be careful. Only employee contribution is restricted to 150. And over and above that, additional deduction also is given 50,000 under section 80CCD subsection 1B. Okay, but anyway, what we are claiming now is for employer contribution. Monetary limit is not there. Percentage limit is there, yes. But can it be more than 1,50,000? Yes. So can you claim deduction for entire 2,01,600? Yes, people. So which is the option? We will straight away choose that. Under subsection 2, please be careful. Under default scheme, only 3 deductions are allowed in chapter 6A. Which are those? 80CCD subsection 2, that is employer contribution to NPS. Then 80CCH subsection 2, employer contribution to Agnipath scheme. Then 80JJAA, that is the additional wage deduction for the wages paid to new regular workman or salary paid to new regular workman. 30%. Yes, sir. Okay. Hope you guys are clear with that. Next. Examine the applicability of advance tax provision in the hands of Rashmi, assuming she does not have any other income chargeable to tax, ignoring the income from house property gifted by her to her family as mentioned above. Means they are telling you for Rashmi, except professional income, she doesn't have anything else. Sir, what about house property? They are asking you to ignore house property. Okay. What is her gross receipts from profession, guys? 45 lakh. And she is willing to follow 44 ADA. So, into 50% is the income. What is the presumptive income under section 44 ADA? 22 lakh 50,000. So, 22 lakh 50,000, assuming she is disclosing that. So, that would be the professional income as well as total income. As well as total income. Because she doesn't have anything else. So, straight away, the PGBP income will become total income. And what will be our tax liability, guys? What will be our tax liability? No, I don't want you to calculate fully. Just tell me, will it be less than 10,000 or more than 10,000? More than 10,000. When the advance tax liability or tax liability of an assessee is more than 10,000, are they liable to pay advance tax? Yes. And you can see here, the total income would be 22 lakh 50,000. So up to 4 lakh under default regime, it is nil. 4 to 8, 5%, 8 to 12, 10% like that. So definitely our tax liability will be more than 10,000. Guys, they don't want you to calculate actual tax liability. Don't do that. Just roughly tell. Is it more than 10,000? Yes. So is she liable to pay advance tax? Yes. Now tell me, is it in one installment or 4 installment? It is in one installment, guys. For an assessee who is following presumptive scheme under section 44 AD for business or ADA for profession, for them, the advance tax liability is in one installment. They have to pay their entire tax on or before 15th March of the financial year in one shot. Whereas if an assessee is following presumptive scheme under section 44 AE, that is for goods carriage business, for in that case it will be 4 installment, or in any other case also 4 installment. But if they are following presumptive scheme under section 44 AD or ADA, it will be only one installment, guys, on or before 15th March of the previous year. Okay, chalo, let us see. Rashmi does not have any liability to deposit advance tax. No, this is wrong. Then the due dates for the deposit of advance tax by Rashmi is 15th June, 15%. No. For her, no, it is not for 4 installments. For others, it is 4 installment, not for her. Rashmi needs to deposit the entire amount of advance tax by 15th March of the relevant financial year. Correct. This is the right answer. I will just read D also once. Rashmi needs to deposit at least 75% of the entire tax liability as advance tax. No, guys, there is nothing like this. So C. Got it, people? Yes, sir. Next, YKR LLC, a foreign portfolio investor, a non-resident. Okay, so foreign portfolio investor, non-resident, FPI. In India, trading in listed shares and securities throughout the world, bought and sold the equity share of an Indian company listed on a recognized stock exchange in India amounting to 15 crores. Under which head of income, such profit shall be taxed in India. Come on, guys. PGBP na? See, obviously it is not income from other sources. You will be confused whether it is PGBP na capital gains. Come on, tell me. The word trading will confuse you normally. Because he's trading, sir, so he's in that business. The answer is capital gains, guys. Because for a foreign portfolio investor, securities will be considered as capital asset as per section 2 clause 14. 2 clause 14. I will just show you under capital gains head. So you can come to capital asset definition. Capital asset definition. Yes, in capital gains chapter, there you can see capital asset means B I am reading. Any securities held by foreign institutional investor which has invested in such securities in accordance with SEBI regulations. So is it a capital asset for them? Yes. So when they sell it, where is it taxable? Under which head? Capital gains. Because when there is a transfer of capital asset, definitely it will be taxable under the head capital gains, guys. Yes. And foreign institutional investor also will include foreign portfolio investors, sir. Of course, guys. Yes. So this is the MCQ part of May 2026 income tax question paper, guys. Yeah. Now we will discuss the descriptive type. Under descriptive type, question number 1 is compulsory. And out of the remaining 3 questions, you need to answer any 2 questions. Yes. Question number 1, that is the compulsory question, guys. 15 marks question. 15 marks question. So before reading the information given in the question, let us read the requirement first. What is it? You are required to compute the total income and tax liability of Mr. Prakash under both the regimes and suggest the one which is more beneficial to him for the assessment year 26-27. Assuming he has never opted for default tax regime since the relevant assessment year, means in the past he has never chosen default regime. Okay, but now they want you to calculate the total income and tax liability under both the regimes. So totally you are supposed to do 4 calculations, guys. Total income and tax liability under default and total income and tax liability under optional. So totally 4 calculation, a lengthier question, but we'll see what is the information given. Mr. Prakash, a resident individual, aged 64 years, very important. Yes. Why? Because in the answer, in one or the other place, it will play a major role, guys. Especially under optional scheme. Because the under optional scheme for a senior citizen who is aged 60 or more and resident in India, the basic exemption limit will be 3 lakh while computing tax liability. Is in the business of manufacturing tires. Yes, this is also important. He prepare his accounts on mercantile basis. Okay. His statement of profit and loss showed a net profit of 1 crore 20 lakh for the year ended 31st March 2026 after debiting and crediting the following items. Okay, so this would be our starting point, guys, to compute PGBP income. Okay, so the following items has been debited and credited to P&L account already. So we need to decide whether we should add back, deduct it, or just leave it like that. Okay, sir. First one, depreciation as per books, we need to add it back. We need to calculate as per section 32 and we will deduct that. Okay, next, interest paid on loan taken from a scheduled bank to buy pollution control equipment. See point 3 in addition information. Okay, we will see it. Amount of loan 8,52,000 at 10% per annum, which was taken on 1st June 2025. Entire interest paid was debited to statement of profit and loss. Okay, whatever it is the interest on loan to purchase an asset has been debited to P&L. Okay. So they're asking us to refer the third point. We will just refer it and then go back. He also imported an air pollution control equipment falling under 15% block, which was previously used outside India by the seller at a cost of 10 lakh on 1st June 2025. Guys, as it is already used outside India, no additional depreciation on it. Even though it falls under plant and machinery block, even though assessee is engaged in the manufacturing business, no additional depreciation. Please be careful. The additional depreciation is only on new plant and machinery. Okay. For this purpose, it took a loan from a scheduled bank amounting to 8,52,000 at an interest rate of 10% per annum on 1st June 2025. The equipment was delivered on 15th September 2025 and was put to use on 1st October 2025. Okay, put to use date is important. Guys, if a loan is taken or borrowed for the purpose of purchasing an asset, whatever interest is paid up to the date the asset is put to use has to be capitalized as per section 43 subsection 1. As per section 43 subsection 1. Yes, sir. So how much interest has to be capitalized? Amount of loan is 8,52,000. Yes, sir. Interest rate is 10%. Yes, sir. Date of loan is what? 1st June 25. And put to use on 1st October. So, sorry, date of loan is 1st June year. Okay, 1st June 2025. June, July, August, September. So for 4 months, interest has to be capitalized, guys. For 4 months, interest has to be capitalized. Remaining interest, that is from October, November, December, January, February, March. This can be claimed as an expenses. That is revenue expenses. But here they told entire interest expenses has been debited, it seems. So what should we do? Whatever we will capitalize, no, that part we need to add. That part we need to add, not the entire interest. Only that 8,52,000 into 10% into 4 by 12. Only that part which we are adding to the cost. We will claim depreciation on the increased cost, right? Yes. So that part has to be added here. Okay, that is 8,52,000 into 10% into 4 by 12. That is the interest component which is capitalized to calculate the cost of an asset. Section 43 subsection 1 talks about the actual cost of an asset to add it to the block, guys. Okay, sir. Fine. Next. Purchase of raw materials includes an amount of 1 lakh towards purchase made from micro enterprise. Okay, micro enterprise, important. As per section 15 of Micro, Small and Medium Enterprises Development Act 2006, the purchase was made on 1st February 2026, but the payment was made on 20th July 2026, next financial year, within the due date of filing the return of income. Okay, but that is not important for us. There was no agreement as regards the payment terms with the seller. Guys, when there is no agreement, payment has to be made within how many days? 15 days of receiving the goods or services. So here, the date of transaction, the purchase was made on 1st February, but payment is made on 20th July after 15 days. So can it be claimed on accrual basis? No, it will be allowed, but on payment basis. But what is the year of payment? The financial year 26-27. That is next financial year. So can we claim it in the current year? No, we need to add it back. We need to add it back. I will just show that provision in PGBP chapter 43B. You can just come to 43B. Guys, please be careful. Under section 43B, there are number of items covered for the following expenses. For the following expenses, it is not allowed in the current year if it is not paid within the due date of filing the return of income. Whereas for the payment made to micro and small enterprise, the time limit is different. They tried to confuse you by giving that also. They told that it is paid in July within the due date of filing the returns. But is it relevant for this payment? No. Because the payment made to micro and small enterprise is covered under section 43BH, for which the time limit is different. When there is no agreement, payment has to be made within 15 days of accepting the goods or services, guys. In the given case, it is not made. Hence, disallowed. Hence, disallowed. Yes, sir. Next. Interest of 2,50,000 gross on enhanced compensation on compulsory acquisition of his factory building by the government based on a court order. However, he actually received the amount in his bank account on 20th May 2026. Guys, listen, interesting. 2,50,000 is the interest on enhanced compensation. Interest on enhanced compensation. Interest on compensation or enhanced compensation received because of compulsory acquisition will be taxable on receipt basis in the year in which it is received. Sir, assessee is following mercantile basis or accrual basis, doesn't matter. Doesn't matter. Interest on compensation or enhanced compensation will be taxable on receipt basis under the head income from other sources. And there is also a flat deduction of 50%. But in this case, it is received on 20th May 2026. That is next financial year. So in the current financial year, is it taxable? No, sir. It is not taxable. So what should we do with this? Deduct it. Already it is credited, so profit has gone up, so deduct it, guys. Next, 50,000 given as contribution through an account paid check for a brochure of political party actively working in a vicinity of a factory and registered under section 29A of the Representation of Peoples Act 1951. Guys, this is also disallowed. As per section 37(2)(b), it is disallowed. As it is not related to the business, we cannot claim it as business expenditure. And it is already debited, so add it back. Next, 2 lakh received as dividend from Indian companies during the year. This is taxable under IFOS, guys. So as it is already credited, what should I do? Deduct it. And credited to P&L account. Interest of 65,000 was incurred on loan taken to earn dividend income has been debited to statement of profit and loss account. All dividends were below the ambit of TDS provision. Means TDS is not deducted. Okay. So they have received 2 lakh, no sir, more than threshold limit. Yes, but it might be from different companies, no? Yes. And 65,000 is already debited, guys. So what should we add back? And what should we do with this? Add it back. Why should we add it, sir? Because both of this, we will consider it under IFOS. But under IFOS, sir, is entire interest allowed? No. Dividend income is 2 lakh people. So what is allowed as interest is actual interest of 65,000, correct? Or 20% of dividend income, which comes to 40,000. So whichever is lower, whichever is lower, whichever is lower, which comes to 40,000. Remaining 1,60,000 would be taxable under IFOS. Hope you understood. Interest expenditure on dividend is restricted to maximum 20% of dividend income. So in our case, dividend income is 2 lakh, 20% of that comes to 40,000. But actual expenditure is 65. So can I claim full 65? No. Sir, can I claim that remaining interest under any other head? No, not allowed, guys. Okay. Coming to additional information. So whatever is being debited and credited, we are done with it. Now additional information. First one. He had taken a housing loan from a scheduled bank for purchase of flat for self-occupation. Okay. On self-occupied property. On 1st April 2025. Interest of 2,15,000 and principal repayment of loan of 1,10,000 is reflected in his bank statement. Municipal tax of 20,000 was paid during the year from his savings bank account. Okay, guys, important. As it is self-occupied property, municipal tax paid is not allowed as deduction. Because for self-occupied property, GAV will always be nil. Only thing which assessee can claim is the interest on housing loan. That too under optional scheme. So, interest on housing loan is allowed under section 24B. Principal repayment is allowed under section 80C, but both only under optional scheme, guys. Both is allowed only under optional scheme. Sir, what if assessee is following default scheme? Then both of them is not allowed. Interest on self-occupied property, not allowed. Principal repayment of housing loan deduction under section 80C, not allowed. Hope you got it. Yes. Next, second point. A new machinery costing 50 lakh, first machinery in 15% block, was purchased on 1st September 2024, last financial year. It was installed and put to use on 24th October, important date. Why, sir? Less than 180 days. Less than 180 days in the last year. Not in the current year, last year. It did not own any other depreciable asset on the date of acquisition of this machine. Guys, interesting. See, on the new plant and machinery purchased and put to use in the factory, additional depreciation is allowed. This is new, please be careful. The next one, that is the air pollution control equipment, that is second hand. On that, additional depreciation is not allowed. Whereas on this new machinery installed in the factory, can we claim additional depreciation? Yes, but only under optional scheme, 20%. But observe, last year, assessee was following which scheme? Optional scheme. Because he never followed default scheme in the past. That means in the last year, he was following optional scheme. Yes. Did he claim additional depreciation? Yes. But how much? As the asset was purchased and put to use for less than 180 days in the last year, he would have claimed less than, as it is less than 180 days, he would have claimed only 10%. That is 50% of 20% is 10%. Remaining 10%, can he claim in the current year? Yes, but only under optional scheme. Whereas under default scheme, it is not allowed. Hope you guys got it. Under default regime, normal depreciation is allowed, but not additional depreciation, guys. Be careful with it. Yes, sir. Okay. Third point, we already read it, guys. We'll move forward. Fourth one. During the financial year 23-24, the central government compulsorily acquired factory building which had been used by him for manufacturing rubber products for the past 5 years. Guys, the year of transfer is 23-24. But in case of compulsory acquisition, as per section 45 subsection 5, it will be taxable in the year in which the compensation is first received. Even if it is received in installment, whenever you receive the first installment, it will be taxable. Yes, sir. Correct. He received compensation of 20 lakh on 15th March 2025, last financial year again, and deposited the whole amount in the capital gains account scheme within the due date of filing the return of income. The building was purchased by him for 5,08,052 on 1st April 2018. The returned down value of the building block as on 31st March 2023 was 3 lakh. He has shifted the production to a leasehold building till the purchase of new factory building. Guys, full this story is irrelevant for us. Sir, why, sir? So big paragraph they have given. You are telling irrelevant? Yes, because transfer happened in the year 23-24. Yes, and the installment or compensation is received in the year 24-25. Yes. So when is capital gains taxable? In the year 24-25, guys. So our current previous year is what? 25-26. So should we be bothered about this compulsory acquisition? No, guys, because it is already taxed in the last year when the compensation is received. Even if it is received in the installment or 20 lakh, let us consider the entire amount is 20 lakh. Still, it will be taxable only in the last year, guys, on receipt basis. This is as per section 45(5) when there is a compulsory acquisition. Yes, sir. So entire story is irrelevant here for our previous year. Next, on 1st April 2025, Mr. Prakash purchased a new factory building which is falling under section 10% block at a cost of 15 lakh. On this, can he claim depreciation? Yes, as it is a factory building, he can claim 10% depreciation, full depreciation, as it is used for more than 180 days. Then cost inflation index for financial year 23-24 and 25-26, they are given, guys. This is again irrelevant. Please be careful because student would have calculated capital gains and unnecessarily wasted time on it. Yes, actually, I am concerned. This is okay. There is no mistake in this, but especially in MCQ, there was one mistake, no correct option. But I am concerned about the students who wrote the exams in May. Why? Because they would have spent time in reading that question, solving it, and once they get the answer, they are not finding it in the option. They will cross check again and again. They will see where they have gone wrong. They would have spent good amount of time on it. But later, if ICAI come up with telling no correct option, then whatever time they have spent in the exam, that crucial 3 hours, can they get it back? Definitely not, guys. I really feel sorry for those who would have written May 2026 exam and spent too much time, especially on that particular question. That is that capital gains calculation in case of slum sale. Yeah, fine. We'll continue. You are required to complete so and so. We already finished. By guys, one thing they have given here. Please be careful with this. They never opted for default regime itself. Means in the past they were following optional scheme. Now in the current year, sir, can they come because they have business income? Can they come to optional? Yes, guys. For the associate who has business income or income under the head PGBP, from default scheme they can go to optional scheme. They can continue under optional scheme. And can they come back to default scheme? Yes, but they can never go back to optional scheme again. So now, assuming they are under optional scheme for the first time, they are continuing with that. If they want to in the current year, can they come to default scheme? Yes, they can come. But in the current year, if they come to default scheme, can they go back to optional scheme in the future? No. Hope you understood. Yes, because they are asking us to calculate under both the regimes. So will it be relevant? Yes, it will be relevant. And also they're asking us to suggest which is more beneficial. Wherever the tax liability will be lower, we will suggest that as more beneficial, guys. Yes, chill. We will see the answer. Computation of total income and tax liability of Mr. Prakash for the assessment year 26-27 under the default tax regime. Under default tax regime. Under section 115 BAC. Okay. Guys, Income from salary, nothing is there. Straight away we'll go to income from house property. Interest on self-occupied property is there, but under default regime it is not allowed. So straight away income from self-occupied property would be nil under default scheme. Yes, sir. Next, profits and gains from business or profession. Okay, better to do this as a working note, guys, because too many calculations would be there here. I would suggest the student to do it as a working note. Yeah. So the starting point would be 1 crore 20 lakh, which is given at the top of the question. Items of expenditure not allowable while computing business income. Depreciation as per book, add back. We will calculate as per section 32 later. Interest on loan for acquisition of pollution control equipment till the date the asset is put to use. We need to capitalize it. As we are capitalizing it, we are adding it back here. Okay. How much is that, sir? 8,52,000 into 10% into 4 by 12. From date of loan till the date the asset is put to use. So it comes to 28,400. Add it here. Same thing should be added to the cost of the asset. Okay. So we are disallowing here and we will add it to the cost of the asset to claim depreciation. Then payment to micro enterprise, as I already explained this, as the payment is not made within 15 days, it will be allowed on payment basis, but in the next financial year. So in the current year, add it back. Next, expenditure in the brochure of a political party as per section 37 2B. This is disallowed, not related to business. Yes, sir. Then interest on loan taken to earn dividend, we will consider this under IFOS. It is not allowed as business expenditure, so add back that also. So the total addition comes to 12,43,400. Okay, sir. They have also done it subtotal here. Next, less items credited but not taxable or taxable under other heads. Interest on enhanced compensation on compulsory acquisition. This will be taxable, but in the next year, guys. So remove that on receipt basis. Next, dividend from Indian company will be taxable under IFOS. So remove it. 2 lakh. So total deduction is 450. Anything deducted, better put it in bracket. 4 lakh 50. Okay. Next, depreciation. This is one of the important adjustment, guys. Depreciation as per income tax rules. That is as per section 32. You can also mention the section. They are not given the section, but you guys can mention 32. Depreciation on machinery purchased in 24-25 last year. First, we need to calculate what is the opening WDV. Important. Guys, opening WDV. Where is it? Yeah, they have taken it here. Actual cost is 50 lakh as on 24th October 2024. Now tell me, last year the asset was put to use for how many days? Less than 180 days. Less than 180 days. Correct? Yes. On or after 4th October. Hope you remember the date, 4th October. Yes. So it is after 4th October. So it is less than 180 days. Yes. So last year they would have claimed a normal depreciation as well as additional depreciation. Sir, why additional? We are doing a default regime. Guys, we are doing default regime calculation and for the current year. But in the last year, did they follow optional scheme? Yes. That last line of the question I read again and explained. Yes. So as last year they have followed optional scheme, they would have claimed additional depreciation, but only 10%. Only 10%. Okay. Fine, sir. For last year, should we reduce both normal depreciation and additional depreciation? Yes. So actual cost is 50 lakh. Normal depreciation is 15%, but 50%. 15 actual rate, but 50% of that, which comes to 7.5%. Yes, sir. 3 lakh 75. And additional depreciation, guys, this is also very important because normally student might miss out this. As we are doing default regime calculation, sir, here in the heading we gave default regime. Yes, for the current year we are doing the calculation under default regime. You guys are right. But here we are calculating the opening WDV for this asset. While calculating opening WDV for this asset, last year the SLC followed optional scheme. He would have claimed additional depreciation. So should we reduce it? Yes, we should reduce it. Please be careful, guys. Maybe those who have written May 2027, May 2026 exam would have missed this part, but please be careful with this. Additional depreciation for previous year 24-25, that is last year when he was following optional scheme. How much is that? Actual cost into 20% is the rate of additional depreciation, but as the asset is put to use for less than 180 days, only 50% of it, which is 10%. Which is 10%, comes to 5 lakh. 5 lakh. Yes, sir. Both of this has to be reduced. So what was the closing WDV at the end of last year? It is 41 lakh 25,000. That becomes opening WDV for the current year. Yes. So on this, we will claim depreciation in the current year. And please be careful. This is for last year calculation. Can we claim it in the current year? No, no, no. I just wanted to find out this figure. That is why we did this. Hope you got it. So using this, we will claim current year depreciation. So on 41 lakh 25,000 into 15% in the current year, full guys, full. Okay, please be careful. This is the depreciation for the current year. This part, this figure, normal depreciation. Sir, what about additional depreciation on this? No. Sir, last year only 10% was claimed. So that means remaining 10%, which is again 5 lakh, we need to claim in the current year, but only under optional scheme. As we are doing the calculation currently, right now, under default regime, this 5 lakh will again not be allowed in the current year, guys. Please be careful. Remaining 10% actually will be allowed in the subsequent year, but only if the assessee is following optional scheme. Hope you understood. Hope you understood. I repeat, I will repeat this. Guys, for last year, we reduced both normal depreciation and additional depreciation in order to know what is the opening WDV. While calculating the opening WDV for the last year, we reduced additional depreciation also because the assessee was following optional scheme in the last year. But in the current year, can you claim additional depreciation? No. Sir, in the current year, the asset is already old, no, sir? Yes. But in the last year, they claimed only 10%, no? That is 50% of 20% comes to 10%. Yes, which is 5 lakh. If the assessee was continuing under optional scheme, then you would have claimed 5 lakh even in the current year. Under optional scheme, it will come, but not under default scheme. So under default scheme, only normal depreciation, guys. This is ND, normal depreciation. Hope you got it. Yes. Next, depreciation on air pollution control equipment. 10 lakh is the cost plus the interest part which we are capitalizing as per section 43 subsection 1. Add back that. Clear? We disallowed it earlier, no? Yes. So that one we need to add here. So the total cost of this asset comes to 10 lakh 28,400 on that 15%. Sir, what about additional depreciation on this? Not allowed due to two reasons. One, first thing is it is not new plant and machinery. It is a second-hand plant and machinery. Whether it is used in India or outside India doesn't matter. No depreciation on second-hand machinery. Okay. And moreover, we are under default regime. So due to these two reasons, it is not allowed. Sir, under optional scheme, is it allowed? No, because it is second-hand machinery. No, not allowed. Okay. So 1,54,260 and factory building is purchased. At the end they have given 15 lakh into 10% claim depreciation. Additional depreciation is not allowed. That is, they have given here balance additional depreciation because last year we had claimed only 10%, but not allowed under default regime. Yeah. So the total comes to here 9,23,000. So what is the business income, guys? 1 crore 18,70,390. Hope you got it. If you want, you can go back and check again if you have any confusion in any point. Coming to capital gains, not taxable, guys. Not taxable. It would have been taxed in the previous year, 24-25. So in the current year, not taxable. Then income from other sources, interest is not taxable. It will be taxable in the next year on receipt basis. Then dividend from Indian company 2 lakh and interest maximum 40,000. This calculation I have already shown. So remaining is 160. Take 160 to the outer column. So gross total income is 1 crore 20 lakh 30,390. Deductions under chapter 6A not allowed. Okay, sir, should I mention like this and mention each section and tell not allowed? Instead of that, you can tell chapter 6A deduction is not allowed under default regime. Except 80CCD subsection 2, 80CCH subsection 2 and 80JJAA. But all these three is not there in this question. So no deductions under chapter 6A, guys. Okay. So the total income would be 1 crore 20 lakh 30,390. Now let us do tax calculation. So under default regime, the basic exemption limit is 4 lakh. So up to 4 lakh nil. 4 to 8 lakh 5% comes to 20,000. 8 to 12 lakh 10% comes to 40,000. 12 to 16 15% comes to 60,000. Then 16 to 20 20% comes to 80,000. 20 to 24 lakh 25% comes to 1 lakh. More than 24 lakh 30%. So do the calculation. 1 crore 20 lakh 30,390 minus 24 lakh, you will get this figure into 30%. Okay. So we are getting a gross tax liability of 31,89,117. And as the total income is more than 1 crore, even surcharge would be applicable. Up to 50 lakh, no surcharge. 50 to 1 lakh, sorry, 50 lakh to 1 crore, 10%. More than 1 crore up to 2 crore, it would be 15%. So in this case, it would be 15%, guys. Default regime. Yes, sir. So 15% surcharge on gross tax, which comes to 4,78,368. Now add up both of this. Sir, should we check marginal relief here? No, guys. Total income has crossed 1 crore by a bigger amount only. That is 20 lakh is in excess of 1 crore. So please don't check it. Even if you check, you will not get it. Means you will not get means not marks. Marginal relief will be 0. Okay, yes. But don't need to check because so unnecessarily don't waste your time. Then health and education says 4%. So tax liability comes to 38,14,184. Please round it off. As it is 4 less than 5, round it off to 180. As per section 288B, tax liability. Please do this without fail, guys. If not, you will lose at least half marks, half or 1 marks. Next, we will continue with the total income and tax liability calculation under optional tax regime. Sir, can we take the total income calculation as per default regime as a base? Yes, that would be a better idea, guys. If not, if you are starting from 0, you will consume too much time. Please better take the total income as per default regime as a base. Clear? Yes. So 1 crore 20 lakh 30,390 is the total income as per default regime. Make the necessary adjustments. First one. Better take deductions later, guys. They have taken first deduction and then they have made an adjustment. Okay. Yeah, better I will do this. Balance additional depreciation on machinery purchased in 24-25. Additional depreciation. Last year only 10% was claimed. No. Last year we were following optional scheme. In the current year also, if I'm continuing with optional scheme, can I claim it? Yes. Next, additional depreciation on air pollution control equipment is not allowed because it is second hand. Then interest on loan for self-occupied property, is it allowed? Yes, maximum 2 lakh. And that will be the loss from self-occupied property. Can loss from self-occupied property be adjusted against income from other heads? Yes, but maximum 2 lakh. Here anyway 2 lakh, we can adjust it. Please be careful, it is under optional scheme. Yes, sir. Fine. Then deduction part. Deduction under section 80C for principal repayment of loan to bank is 1,10,000. 1,10,000. Yes. Interest also allowed. This is under section 24 subsection B, guys. Whereas principal repayment is allowed under 80C. Maximum is 1,50,000, but here anyway it is within 150. Claim it full. Then deduction under section 80 GGC not allowable in respect of expenditure in brochure of political party. You see, GGB is for Indian company, whereas GGC is for others. And here the assessee is not an Indian company. It is other than a company. Clear? So I guess it was Prakash, individual or sole proprietor. So for them, is the 80 GGC deduction allowed for an expenditure in brochure of a political party? No, guys. Yeah. So 1,10,000 is the total deduction. Here also 7 lakh we need to reduce. So what is the total income under the optional tax regime? It would be 1 crore 12 lakh 20,390. Here also surcharge would be applicable. Yes, sir. So what is the basic exemption limit under optional scheme, guys? 2 lakh 50 or 3 lakh? 3 lakh. Please be careful. Assessee is a resident senior citizen. So the basic exemption limit would be 3 lakh, guys. So up to 3 lakh nil. 3 lakh to 5 lakh, it is 5%. Comes to 10,000. Then 5 lakh to 10 lakh, it is 20%, which comes to 1 lakh. So more than 10 lakh. So that is you do total income minus 10 lakh. You will get 1 crore 2 lakh 20,390 into 30%. You will get this figure. So gross tax liability will be this. Better you close the amount column here. If not, you will add that also. Better to close like this. Yeah. So gross tax liability is this much, sir. Should we add surcharge? Yes. As the total income is more than 1 crore but up to 2 crore, surcharge would be at 15% under optional tax regime. Same rate. Yes, sir. Take it. And 15% is on gross tax. Please be careful. Don't take it on income figure, guys. Applicability of surcharge depends on the total income. But the rate of surcharge has to be applied on gross tax. Yes, sir. Then health and education cess will be at 4%. So the tax liability is coming to 37,98,636. More than 5. So round it off to next 10 rupees. 640. As per section 288B. Total income has to be rounded off to nearest 10 rupees as per 288A. Whereas tax liability as per 288B, guys. Okay. Then they have also asked the suggestion. See, after doing so much calculation, I know student will be like tired. But thank God I have completed this. Let me move forward. But don't forget this suggestion. They asked this also. And if you don't write it, at least after 1 mark, they will deduct it. Since the tax liability of Mr. Prakash under optional tax regime is lower than the tax liability computed under section 115 BAC, it would be beneficial for him to opt out of default tax regime under section 115 BAC for assessment year 26-27. Guys, he is already following optional tax regime actually. He will continue with it. Clear? Yes. Fine. Done with question number 1, guys. We'll go to question 2, which will have 2 sub questions. I will just read the requirement once. Okay, when the question is lengthy, better read the requirement and then go back and read the data, guys. Determine the residential status of Mr. Shankar as per the provisions of Income Tax Act 1961. Okay, residential status, section 6. And compute his total income for assessment year 26-27, assuming he did not opt out of default tax regime. Means he's following default tax regime. Correct, people? He is following default tax regime. We are supposed to calculate total income. Okay, under default. 6 marks question. Mr. Shankar, aged 44 years. Okay, age is 44, less than 60. Is an Indian citizen. Okay. He graduated from ABC University, UAE, outside India, and was employed in Nomad Skills LLC, UAE, since April 2016. He never visited India in between, so he settled outside. He resigned from Nomad Skills LLC in November 2025, completed all the formalities while staying in UAE till 10th December 2025, and came back to India on 11th December 2025. Date of arrival also is counted to be in India. To join Sakin Pro Limited as CEO of the company. He received gross salary amounted to 36 lakh from Nomad Skills LLC up to November 2025 in UAE for the year 25-26 in his bank account maintained in UAE. Purely foreign income earned and received outside India. Okay. His salary was not taxable in UAE since UAE does not tax individuals on their income. Okay, guys, they are giving a hint for deemed resident. Deemed resident under section 6 subsection 1A. He received gross salary from Shakin Pro Limited from December 2025 to March 2026, that is in India, amounted to 8,50,000. Gross, guys, it is. Please take care of the standard deduction. Yes. He also sold listed equity shares of Indian companies. So it will be Indian income only, which were sold by him in October 2025 as per the following details. Sir, in October he was outside India. It doesn't matter. It is a share of Indian company. So income deemed to accrue or arise in India only. Yes. So the following details. What is it, sir? Name of the company, First X Limited. Number of shares is 300. Date of acquisition 15th February 2016, guys. Please be careful. This is before 1st February. 1st February 2018. So cost calculation would be different. Cost of acquisition is 1,400. Date of transfer is 23rd October 2025. That is our previous year. Sale price per share 3,200. And FMV as on 31st January 2018 is 1,800. Okay. This is given. Is this relevant? Yes, it is relevant. This is relevant for this case. Next, Y Limited 250. Purchase date is 1st August 2023. Okay. This is after 1st February 2018, guys. Okay. Cost calculation would be straight away actual cost. Cost of acquisition is 2,300. Date of transfer is 8th October 2025. Sale price per share is 3,300. FMV as on 31st January 2018 is given, which is not relevant here. Why not relevant, sir? Because it is purchased after 1st February, guys. Is that clear? So we need to compute actually long-term capital gain here. As per which sections are 112A. It is a listed securities and STT is also paid, you can see on. STT was paid both at the time of purchase and sale. And sir, is both long term or short term? Both long term. Guys, for listed shares, what is the period of holding? 12 months. Both of them has been held before transfer for more than 12 months. You can see here 2016 to 25, of course, more than 12 months. Here also more than 12 months. Both are long term, but cost calculation is different. Cost calculation is different, guys. So please be careful. Just a minute, I will show you. It is a part of capital gains, 112A. Cost calculation. Yes. So you can see cost of acquisition of certain assets. No. Yes. Last part here. Long-term capital assets being so and so. Listed equity shares also is covered as per section 112A. if it is acquired before 1st February 2018, what would be the cost of acquisition, guys? Cost of acquisition shall be higher of actual cost of acquisition or lower of FMV as on 31st January and actual sale consideration. So what you do is first compare this two, take whichever is lower, then compare that with actual cost. One second. So compare this two, take whichever is lower, then compare this with actual cost, take whichever is higher. That is the cost of acquisition. Sir, will indexation be available? No. In both cases, indexation is not available. Guys, as per section 112A, no indexation, even though the asset category is long term. Okay. Then, sir, what if it is acquired on or after 1st February 2018? Then this story will not be there. Only actual cost. That's all. So, for this, we need to consider FMB. That is for the shares of X Limited. Because you can see purchase date is before 1st February 2018. Whereas for shares of Y Limited, purchase date is after 1st February 2018. So straight away we need to take only cost of acquisition. No FMB, no sale value to decide cost of acquisition. Hope you guys got it. Yes. He also received winning from online games in India amounting to 70,000 in March 2026. Guys, see, as they use the word received, 70,000 can be considered as net amount of TDS. But what I would suggest is, if question doesn't mention anything about TDS, like net of TDS, or in the bracket sometimes they will give TDS amount. If they are not mentioned anything like that, you can consider this only as gross figure. No need to gross it up. Consider this only as gross figure. Alternatively, sorry, as they have used the word received, can I consider this as net and then gross it up? Yes. So in that case, gross amount would be 70,000 divided by 70%. Sir, how did you get this 70%? 100 minus TDS rate. On this casual income that is winning from online games, what is the TDS rate, guys? 30%. So what I will receive is after 30% deduction, which is equivalent to 70% of what I have earned. Hope you guys got it. Then, sir, what do you suggest? Better, as they have not used the word TDS anything here, better to take 70,000 as gross figure only. Okay, and you can also give a note telling 70,000 given in the question with respect to winning from online games is considered to be a gross amount. That's all. Okay. So determine residential status and total income. Okay, sir. How many days he was in India, guys? Come on. He came on 11th December. Okay. Let us count it quickly. Come on. You can also do it in the calculator only. December, 31 days. Minus, he came on 11th, no? So 11th is counted to be in India. You do 10 minus 10. So 21 days. Then January, 31 days. February, 28 days. Then March, 31 days. Add up everything. Add up everything. Yes, sir. So that day, that many days he was in India. Yes. Chalo. And is he covered in that special case where, sir, he was settled outside India, he came to India? Guys, please be careful. He came to India to settle here, not for a visit. So he will not be covered in the special case. Please be careful. That means both the conditions are applicable for him. Yes, 182 days or more. Second one, 60 days or more during previous year and 365 days or more during 4 years preceding the previous year. Both are applicable for him. But let us see. Let us see. Because in the past he was never in India. Only during previous year is coming. Yes, sir. Mr. Shankar is an Indian citizen who stayed in India during the previous year 25-26 for 111 days and never visited India since April 2016. Okay, he never was in India from 2016. So history, last 4 years if you check also, 0 days. Since is not a resident by virtue of section 6.1. Can we check section 6.1 here? Yes. Guys, see, please be careful. Sir, only first condition is applicable for him or both the condition? Both the condition. He is not covered in that exception case because he was settled outside India for employment. Yes, right. But is he coming to India during the previous year for a visit? No, he is coming to settle back here. So both the conditions are applicable, but the problem here is he is not satisfying both. In the previous year, he was in India for 111 days. I showed the number of days in each month. Yes, no. So in the past, he was not in India. So first condition, 182 days ruled out. Second condition, 60 days satisfied, but 365 days not satisfied. So both has to be satisfied under second condition. But second part, that is 365 days not satisfied. So he is not a resident as per section 6(1). Only when he is not a resident as per section 6(1), we need to go and check section 6(1)(a). Chalo. Is not liable to tax in UAE. He will be deemed resident under section 6(1)(a) if his total income other than the income from foreign sources exceeds 15 lakh. Correct? One by one conditions you check. He is a Indian citizen. Okay. And he is not paying tax in UAE. Very good. And the last one is Indian income should be more than 15 lakh. That is total income other than the income from foreign source. Correct, people? That is what is given in section 6(1)(a), right? Just a minute. I will show you. Residential status. Yeah. So you can see, if by chance, if you get a doubt about this. Yeah, this one. Indian citizen who is in employment outside India is coming to India for a visit during previous year. So will that guy fit in here? No, because he's not coming for a visit. Okay. But we need to check the deemed resident. So is he an Indian citizen? Yes. Is he paying tax in foreign country? No. He is not liable to tax in any other country. But we need to check his Indian income. Now. Got it? Yes, sir. Sure, we will see. Income from salary from foreign country, whatever he is getting, it is not income earned or received in India. So we will take it as nil. So it will be purely foreign income earned and received outside India. Then gross salary from Shekin Pro Limited, that is in India, 8,50,000. Please provide for standard deduction. You might miss out this. Please be careful with this. So taxable salary is 7,75,000. Then come to capital gains. As it is the shares of Indian company, it will be Indian income. First, sale consideration of X Limited, 300 shares into 3,200, selling price 9,60,000. Cost of acquisition, we need to do this calculation as per section 112A. What is it? Cost of acquisition you take, then compare that with lower of FMV and sale consideration. 5,40,000 is the FMV as on 31st January. Then the sale consideration is 960. Take the same. Okay. So whichever is lower, 5,40,000. Compare this with actual cost, 420. Whichever is higher, 540. So cost of acquisition would be 540. Remaining long-term gain is 420. 4,20,000. Transfer of shares of Y Limited. Sale consideration you take 8,25,000. Straight away cost of acquisition. No comparison, nothing. Because this was purchased after 1st February 2018, guys. I have explained it already. So the gain is 2,50,000. Both this gain comes under which section? 112A. And you know, under section 112A, long-term capital gain in excess of 1,25,000 is taxable at 12.5%. So should I reduce 1,25,000 year only? No, please don't reduce it. That is only while calculating tax. Don't reduce that amount here, guys. Please be careful. That reduction is only while calculating tax. Okay. Income from other sources, 70,000 is taken here, considering that only as gross figure. Alternatively, if you consider that, sir, 70,000 received is given, so we will take it as net of TDS. In that case, you will consider 30% TDS is already deducted. Gross figure would be 70,000 divided by 70%, which will give us gross figure 1 lakh. In that case, even total income figure will change. But anyway, answer will remain same only. Answer residential status will remain same only, but only the figure will change. Clear? Sir, what will you suggest? As nothing is mentioned about the TDS in the question, guys, better to take 70,000 and just give a note telling the figure given in the question is considered to be a gross amount. Okay, sir. Total income 15,15,000, 15,50,000. Sorry, 15,15,000, more than 15 lakh. So is he a deemed resident? Yes. And whenever he is a deemed resident, as per section 6(1)(a), he will always be not ordinary resident, guys. Not ordinary. Sir, should we check additional condition under section 6(6)? No need. No need. Please be careful. If an assessee or if an individual is a deemed resident as per section 6(1)(a), straight away is a not ordinary, guys. Hope you got it. Yes, sir. So the total income would be 15,15,000 only. If he is a not ordinary resident, then will this income be taxable? No. But if he is an ordinary resident, assume his residential status would have become ordinary, then even this would have been taxable. The total income would be increased by this amount, But anyway, in this question is the not ordinary. So the total income will be 15,15,000 itself. Hope you got it. Yes, sir. Let us move forward. Examine the applicability of tax deducted or collected at source, that is TDS or TCS, as per the provisions of Income Tax Act 1961, and calculate the amount of TDS or TCS for assessment year 26-27 in the following independent situation. Means each of them is different. 4 marks. So it would be 2 marks each. 2 marks each, guys. What is it? First one, Stylo Enterprises, an Indian partnership firm, deals in branded handbags and wristwatches. It opened a showroom at a luxury mall in Delhi in April 2025. Mr. X, a resident Bollywood star, purchased a handbag of Gucci, not Gucci, it is Gucci. Okay. Brand worth 12 lakh from Stylo Enterprises. Guys, more than 10 lakh. Purchase value is more than 10 lakh. TCS is applicable at 1% for his wife as anniversary gift on 10th January 2026. He also purchased a wristwatch of Rao brand worth 9,22,000, less than 10 lakh, on 15th January 2026 for his son as his birthday gift. So on this no TCS, whereas on this 1%, guys. 1%. I will just show you. This is a TCS part. Previously only car was there, but recently they have added other items also. If purchase value or sale consideration is more than 10 lakh. Yeah, just a minute. I will come to that. You guys also can open it. TCS. Yeah. So you can see under section 206C, subsection 1F, previously only motor car was covered, guys. If ex showroom price is more than 10 lakh on the sale of motor vehicle, then TCS has to be collected at 1%. But now they have added other items also. This was from May itself. Yes, sir. So you can see here, any wristwatch and handbag also is covered. Wristwatch is here and handbag is here. Sixth point. Yes, sir. So if the sale value is more than 10 lakh, then TCS has to be collected at 1% of sale consideration. Not only the amount in excess of 10 lakh, on the entire sale consideration. So in our case, on 12 lakh, 1%. Yes. And should we see it for each product or aggregate? Guys, buyer obviously will be different. So for each product wise, we need to check. Yeah. We will see the solution. Stylo Enterprises, being a seller, is required to collect tax at source at 1% at the time of receipt of 12 lakh. The consideration for sale of handbag in notified goods, since its value of such goods exceeds 10 lakh. However, since the value of wristwatch does not exceed 10 lakh, no TCS on that. So only on 12 lakh, 1%, which comes to 12,000. That's all. Okay, sir. Then coming back to the question, second part. Robo Limited, an Indian company, made a payment of 3 lakh to Mrs. Sandhya, a resident individual, on 12th April 2025 for the supply of New Year diaries manufactured as per the specification of Robo Limited. However, no material was supplied by Robo Limited to Mrs. Sandhya for the production of such diaries. Guys, this question is like on 194C. Should we deduct TDS under section 194C or not? See, under section 194C, which covers contract work, work is only supply of service, guys. But here, is it a supply of service or supply of goods? New Year diaries. And recipient, that is payee, didn't supply any goods. So that means supplier, that is the seller, will use his books, print on that and give it. So will it be a supply of service or supply of goods? Supply of goods. So is supply of goods covered under section 194C, people? No, it is not covered. So the scope of work there is only service part. Got it? Here, so they have given 3 lakh. Yes, more than threshold limit, but this will not fit in under section 194C because it is supply of goods. What is covered under section 194C is only service, that is contract service. Hope you got it. Yes, so that means no TDS. Since no material was supplied by Robo Limited, that is payee, to Sandhya for production of New Year diaries, the same would not fall within the scope of work. Why? Because it will become supply of goods, guys, or sale of goods. Sale of goods is not covered under section 194C. Now, sir, can we mention about 194Q? 194Q. If the purchase value is more than 50 lakh, yes, TDS has to be deducted. Yes, but here it is only 3 lakh. Even 194Q also is not applicable. Yes. Accordingly, there is no liability to deduct tax at source in respect of payment of 3 lakh to Mrs. Sandhya, since the contract is a contract for sale and not for work. Yes. And sir, can I mention about 194Q also? Why they have answered only 194C? Yes, as it is a purchase of goods, you can check 194Q. But even if you check 194Q, it is not applicable as the purchase value is less than 50 lakh cash. But you can mention that. TDS is also not applicable under section 194Q as the purchase value is less than 50 lakh. Better to mention that. Got it? And if I have to connect this even for GST, guys, even in GST, in case of printing, there is a circular. So in case of printing, assume I want diaries. Along with that, I want printing of my logo on them. So it is a composite supply. But what is the principal supply? Goods or service? That is diary na or printing. I am buying diary. Along with that, I want some printing there. So the principal supply would be the diary, guys. So will it be a supply of goods or supply of service? Supply of goods. Same concept if you apply here. It is supply of goods or sale of goods. So no TDS under section 194C, guys, because 194C covers only service part, contract. Yes, done with this. Next, third question. Third question is for 6 marks, 3A. That's a question A. Let me read the requirement. Compute the total income of Mr. Pratham, assuming he has opted out of default tax regime. For the assessment year 26-27, provide brief reasons for the treatment of items wherever necessary. Okay. Is opted out of default tax regime means people is following which scheme? Opted out of default tax regime. So is following optional scheme. Okay. Chill. We'll see. Mr. Pratham is employed with a private sector company as manager. Let me underline this. Somewhere it might be helpful. As manager, production, stationed in the city of Dhanbad, that is Jharkhand. His monthly basic salary is 80,000. The company also maintains and runs an engineering college in Ranchi, Jharkhand, where his son is admitted to study mining engineering. He gives you the following. Okay, with respect to this, whether fees is charged or not, we don't know. We will see later. He gives you the following additional details regarding his other receipts perquisites from his employer or from others during the financial year 25-26. On 2nd September 2025, he was transferred from Dhanbad to Jamshedpur, Jharkhand, where he was provided with a room in a prominent hotel as a residence for his stay in Jamshedpur from 2nd September to 12th September. So you can see the period of stay in hotel is less than 15 days. The rent of hotel room was 4,500 per day. Guys, in case of transfer, if the hotel accommodation is provided in a new area, that is a new place, if it is up to 15 days, it is not taxable. It is exempt. It will not be taxable. Rent-free accommodation will not be taxable in the hands of employee as perquisite. So is this exempt? Yes, as the accommodation is provided for less than 15 days. Next, his employer sold a car to him on 1st August 2025 for 2,50,000. The company had purchased this car on 1st July 2023 for 5 lakhs. The car fell under 15% block of assets in the books of the company. Yes, guys, important. See, car was sold on 1st August by employer to employee for 2,50,000. So we need to check the perquisite calculation. The actual cost of the car to the employer is 5 lakh. And we need to see how many years it was used by employer before sale. So from this date to this year date, we need to check how many completed years. That is from the date of purchase till the date of sales. So I guess it would be 2 years. 2 years, few months will be there. But sir, 2 years will end on. See, it will be like this. Okay, let me just show it. From 1st July 23 to 30th June 24, 1 year. Again, 1st July 24 to 30th June 25, second year. Yes, sir. Sir, again, should we count July and August? No, because that is months. Any months has to be ignored. So we need to claim depreciation or we need to reduce depreciation for 2 completed years, guys. Okay. And they have also tried to confuse you by telling it falls under 15% block. No. Guys, while calculating perquisite in the hands of employee, what is the depreciation rate as per section 32 is not relevant. That is relevant for employer to claim depreciation. Okay. But now we are under salary head. So for employee, we need to follow the rates given in salary chapter for perquisite valuation. What is it, sir? For motor car, it is 20%. I will just show you. 1 second. Just give me a minute. You can come to salary head. Perquisite calculation. Yes, sir. Yes. When an asset is sold by employer to employee, and in our case, it is motor car, take the cost to the employer and reduce 20% per annum as per WDV method for each completed year of usage by whom? By employer before sale. And amount recovered from employee, which is nothing but sale value, reduce. Balance is taxable as perquisite in the hands of employee, guys. And while reducing depreciation, 20% per annum as per WDV method is for each completed year of usage. And if there is any months, please ignore. In our case, it will be 2 years, 2 months. Correct? Huh? Yes, 2 months has to be ignored. So claim depreciation for 2 years at 20%. Please be careful, guys. This rates doesn't have any connection to section 32. That is under the head PGBP. While computing business income of employer, he will claim the depreciation as per those rates. But this is to compute salary income of an employee. Got it? Yes. Even for RFA, I will just show you here. You can see this is for RFA calculation. But if it is hotel accommodation provided up to 15 days on account of transfer of employee, the perquisite is not taxable. The previous point. Yes, sir. Okay, let us continue. Third one is employer entered into a staff group insurance scheme with a government insurance agency during the financial year 25-26. Is employer paid 2,50,000 as premium on life of Mr. Pratham. Please be careful. Normally, staff group insurance scheme will be health insurance or medical insurance. And if medical insurance policy or health insurance policy is taken on employee for which premium is paid by employer, it is exempt. But here, I guess they have made a mistake by giving a life here at the end. Because if life insurance premium is paid on the life of employee, it is taxable as perquisite in the hands of employee, guys. Got it? So, as it is a staff group insurance, we should assume it as health. And if it is a health insurance premium, it is exempt. But if it is a life insurance premium, it is taxable. So they are trying to confuse you by giving life in between your. Okay. But if you assume it to be health, it is exempt, people. Okay. It is exempt. But if it is a life insurance premium, then it will be taxable. Yes. So what is better, sir, for this kind of question? As they have used the word group here, you can consider it as health. Normally, employer will take the health insurance policy in the name of employees as a group, guys. Okay. Yes. So this they should have not given actually. Fourth one. The annual fee for the other students in the same college in which his son studies is 2 lakh. However, his company provides education to his son for free of cost. Guys, come on. In this, again, perquisite. If employee children is studying in a school or college which is managed or owned by the employer, we need to check the cost of education in the similar institution or in the similar locality. If it is up to 1,000 rupees, nothing is taxable per month. But if it is more than 1,000, fully taxable. Yes, per month, per child it is. Okay, just a minute. I will show you. Yeah. So if children are studying in a school or educational institution owned by the employer, then we will check the cost of education in a similar institution or near the locality. If it is up to 1,000 rupees per month per child, not taxable. The perquisite will be nil. Sir, what if it is more than 1,000? Fully taxable. And what they have given in the question is per year, 2 lakh. So even if I take 1,000 into 12,000. So, sir, is 2 lakh more than 12,000? Yes, fully taxable. Fully taxable, guys. So this is taxable. Okay. He went on a holiday within India with his 3 children, one major son and 2 twin minor daughters. 1 plus 2 it is. Okay, let me write 1 plus 2. Okay, I will use the pen. 1 plus 2. Okay. And his brother was who is dependent on him. The total air and train cost incurred by him on this travel was 3 lakh, that is 60,000 per person. He traveled in an economy class flights or 3 AC train compartment, AC it is, okay. The entire amount was reimbursed by his employer since it was his first trip in last 20 years. Guys, is it exempt? Yes, it is exempt under section 10(5), leave travel concession or assistance. Clear, one by one. Did he go for a trip within India? Yes. Then, sir, did he travel in a specified class? Yes. In flight, it is economic class, not business class, allowed. Then in train, AC, allowed, no problem. Then coming to the people who all traveled along with the assessee, along with the employee, 3 children. Sir, maximum only 2 children, no sir. Yes. But if it is a multiple birth after one, it is counted as one. So, is exemption allowed for all 3 children? Yes. As twins is second, it is allowed, guys. 1 plus 2, all 3 children allowed. Then what about brother, sir? As brother is dependent on him, allowed. Sir, what if brother was independent? Not allowed. In that case, 60,000 would have been taxable. Got it? Yes. So, entire amount is exempt, guys. In simple. Okay, I will just show you. 10(5) it is. 10(5) exemption. Leave travel. Leave travel concession under section 10(5) is for a travel to any place within India, guys. Within India. Okay, in India, that condition is satisfied. Then, if you are going by air, it should be economy class airfare. And if you are going by air, it should be AC. Okay, so class is fine, no problem with the class. Then, whom and all can the employee take with him? Family members. Family will include spouse and children of the individual, whether dependent or not. Okay, spouse and children can be dependent or independent, no problem. Whereas parents, brother, sister of the individual or any of them should be only mainly dependent on him. So in the question, brother is given, which is dependent, satisfied. Now, who is children, sir? I have given here. Exemption is restricted only to surviving children born after 1st October 1998. Sir, how can we take the children who is gone? Obviously, will not make, because they have used the word surviving children. Fine. But multiple birth after first single child will be considered as one child only. So in the given case, 1 plus 2 for all 3 children, exemption is allowed. Yes, sir. Exempt. Next, his wife expired in May 2024 on duty. She was employed with government school as a school teacher. The family pension received by Mr. Pratham during financial year 25-26 is 2,50,000. Guys, this is taxable under the head IFOS, not salary, because he is receiving this as family pension on behalf of his wife. And for this, there is a deduction also. How much is it? He is following optional scheme, so please be careful. It is 1/3 of the family pension or 15,000 per annum, whichever is lower. Okay. Pratham received a sum of 10 lakh from a trust. It is from a trust, so it will be exempt. Registered under section 12AB of the Income Tax Act. Sir, 10 lakh, more than 50,000. Still, it is not taxable. It is exempt. That means, sir, 56 to 10 gift taxation is not applicable. Huh? No, not applicable. It is not applicable as it is received from trust. Okay, sir. Fine. We'll go to the solution. We have discussed everything. We'll quickly go through it. Income from salary under optional scheme, please be careful, guys. That is normal tax regime. Optional scheme, normal tax regime, everything is one and the same. So basic salary 80,000 into 12, 9,60,000. Then perquisite value of rent free accommodation, Mr. Pratham, as it is within 15 days, nil. Okay. Yes. Perquisite value on sale of car, take the original cost 5 lakh, from that reduce depreciation for each year. And as per WDV method, please be careful. So for first year 1 lakh, so the WDV will be 4 lakh after depreciation, and again reduce 20% of 4 lakh 80,000. So we'll get 3 lakh 20. Then from that reduce, this was the value of the asset at the time of sale. From that reduce sale value 2 lakh 50. So 70,000 is taxable in the hands of employee as perquisite. Then premium paid by employer in staff group insurance scheme, considering it as health insurance, exempt, guys. Okay. Yes. And better give a note for this. Yes. Next, education facility provided by the employer free of cost. As it is more than 12,000 per annum, fully taxable, 2 lakh. Then leave travel concession fully exempt, guys. And alternatively, they have told as LTC word is not used, we can consider it as taxable and all. But I don't suggest this. As all the conditions are satisfied, give it as an exemption. Give it as an exemption. Yes. Then standard deduction under optional scheme. Please be careful. 50,000, not 75. Yes. So income from salary will be 11 lakh 80,000. Then family pension is taxable under IFOS 2 lakh 50. For that there is a deduction 15,000 or one third of 2 lakh 50, whichever is lower. So 15,000. Remaining 2 lakh 35 is taxable. Sir, what about that gift? Gift is not taxable, guys, as it is received from trust. So gross total income or total income of an assessee is 14 lakh 15,000. And question is silent about deduction. Assume it to be zero. That's all. 14 lakh 15,000. Okay, so fine. We'll move forward for sub question B. Mr. Avinash, a resident individual aged 45 years, booked an apartment in Pune in the financial year 2021 for 50 lakh in 2021. It took possession of this apartment on 1st April 2025, that is during our previous year. The stamp duty value of the apartment as per the municipal records was on 1st April 2025 was 75 lakh and on the date of booking was 60 lakh. That is somewhere here, date of booking. He had paid 5 lakh by demand draft as a down payment on the date of booking. Guys, important. See, if date of booking and date of registration is different, for the purpose of calculating what is inadequate consideration, what stamp duty value should we take? If at least a part of the consideration is paid in any mode other than cash on or before the date of booking, then we can take the stamp duty value on the date of booking. Correct? Huh? Yes. So now, will we take 75 lakh or 60 lakh? 60 lakh to decide inadequate consideration. Hope you understood, because 5 lakh was already paid by demand draft, and demand draft is one of the notified mode to make payments. Is it okay? So yes. Also on 16th January 2026 is gold chain costing 6 lakh, which was purchased on 20th August 2025, was stolen. Okay. Gold chain was stolen. Theft. During the marriage party, when the FMV of the chain was 13 lakh. On 20th March 2026, he received an insurance claim of 4,50,000 towards this loss. But guys, in case if gold is stolen, will it be taxable? No. No capital gains on this. Why also I will tell you, because it is not specified. Under section 45, 1A, theft, stolen and all is not covered. Okay. Discuss the taxability of this transaction in the hands of Avinash. Assume it did not opt out of default tax regime for assessment year 26-27 and it did not have any other income during the year. Okay. Is this taxable? We need to check inadequate consideration. Guys, when an immobile property is purchased, as per section 56 to 10, 56 to 10, if there is any inadequate consideration, then it can be taxable. Now we need to check what is inadequate consideration first. That is stamp duty value minus the actual purchase price. And to calculate the stamp duty value, sir, should we take date of booking or date of registration? Date of booking or date of agreement is one and the same. Okay. So here the stamp duty value on the date of agreement is 60 lakh and on the date of registration is 75 lakh. That is possession date. But as at least a part of the consideration is paid by demand draft before, that is on the date of booking, that is date of agreement, we will take stamp duty value as 60 lakh. Okay, sir. We will take 60 lakh. What is the actual purchase price? 50 lakh. Okay, sir. So how much is the inadequate consideration? 10 lakh. Check whether it is more than two things. What is that two things, sir? 50,000 or 10% of actual consideration. 10% of actual consideration is 50 lakh into 10%, 5 lakh. So whichever is higher, 5 lakh, guys. So inadequate consideration 10 lakh is more than 5 lakh. So this is taxable as income from other sources. Income from other sources in the hands of purchaser. And obviously it will be a capital asset for the purchaser. So it is taxable, guys. 10 lakh. Inadequate consideration. Hope you got it. Whereas this is not taxable. This is not taxable. I will just show you with respect to this. Capital gains, right? Yes. Just a minute. You can come to section 45 1A. Section 45 1A, which talks about insurance receipts. I will just read it out. You can see, you can listen. If the assessee receives any money or other asset from an insurance company because the asset was destroyed due to natural calamity or enemy action. Sir, your theft is enemy action. No, no, no. The income will be chargeable to tax in the previous year in which such sum or other asset is received. Whereas in our case, it was theft. So, will it be taxable? No, guys. Even though the insurance compensation was received, it's still not taxable. So, on gold and all, can we receive? Can we take insurance policy? Yes. Now you can take, as it is high value asset. You can take. Sure. So, in first case, guys, 10 lakh would be taxable. 10 lakh would be taxable. They have not mentioned 10 lakh. Huh? Difference between 60 lakh and 10 lakh. Should have written the amount 10 lakh. Paid would be taxable in the hands of Mr. Avinash, which is nothing but 10 lakh under section 56(2)(10), since the difference exceeds 5 lakh, being the higher of 50,000 or 10% of consideration, which is nothing but 5 lakh. Okay. Stamp duty value on the date of booking can be considered since Mr. Avinash has paid down payment by demand draft. Okay. And in this case, there is no capital gains. Insurance received for loss of gold chain due to theft is not covered under section 45 1A, since such loss does not occur due to the circumstances specified thereunder. Hence, insurance claim of 4,50,000 is capital receipt but not taxable. Okay, yes. Fine, guys. The last question, sub question A. One of the important question, guys, because there is some confusion here with respect to house property loss and all. Yes. Compute the gross total income of Mr. Navyam for assessment year 26-27, assuming he has opted for default tax regime. Okay, default tax regime. Provided under section 115 BAC of Income Tax Act 1961. Next, list out the losses to be carried forward to further assessment year, specifying the assessment year up to which such losses can be carried forward. And for 4 marks, what they have asked is too much. That to 2 requirements. You see the question here. By the time the student read question itself, Mr. Navyam, a resident individual aged 39 years, age will not matter, gives you the following particulars about his income for the previous year 25-26. Profit from chemical dealership business, normal business, 273. Income from speculative business, special business, 180, 1,90,000. Loss from betting, guys, loss from betting cannot be claimed, cannot be adjusted, cannot be carried forward. Okay. Gross dividend from Indian companies, IFOS. Loss on maintenance of racehorse, it is a special loss which can be adjusted only against same nature. That is income from maintenance of racehorse. That is owning and maintaining racehorse. If not, you can carry forward it to next 4 years. Rental income computed as per the relevant provisions of the Income Tax Act 2,52,000. So this is income from house property. So this is IFOS. Let me just write IFOS. This is PGBP. Even this is PGBP. Yeah. Then loss from self-occupied house property. Guys, as the assessee is following default regime, interest on self-occupied property, that is housing loan, interest on housing loan for self-occupied property is not allowed. So can they have a loss from self-occupied property? No. Under default regime, the income from self-occupied property will always be nil, guys, because interest is not allowed as deduction. Interest is not allowed as deduction. Yes, sir. Next, his minor daughter has won the award from dance performance in TV. This amount was given to his father. Doesn't matter. Sir, here clubbing will be applicable. No clubbing. So it will be taxable in the hands of daughter itself. Sir, it was given to father. Doesn't matter. If she earn anything out of this 3 lakh will be clubbed with father. But not now. 3 lakh will not be clubbed. Okay, sir. Next. Profit from the business specified under section 35 AD. Special business. 6 lakh 50. This also comes under which head, sir? PGBP. Okay. The other details of unobserved depreciation and brought forward losses pertaining to different assessment years. So whatever we have read till now is from current year. Now whatever we will read from now till now it was current year. From now it will be past years. Unobserved depreciation for assessment year 23-24, 6 lakh 80 can be adjusted against any income except salary. And against casual income, you cannot adjust any loss. Against casual income and undisclosed income, you cannot set off anything, guys. Yeah. Loss from happy stay business pertaining to assessment year 23-24 allowed 2,10,000, but you can adjust it only within business head, PGBP. Loss from speculative business pertaining to assessment year 22-23 1,60,000. Guys, speculative loss can be carried forward only for next 4 assessment year. So if you add 4 years for 22-23, it will be 26-27. So current year you can adjust. If not, forget it. It will expire in the current year. Next, pertaining to assessment year 2021, 2,20,000. Guys, if you add 4 years for it, it would be 24-25. So this loss is already expired. So in the current year, can I adjust it? No. So this 1,60,000 can be adjusted against income from speculative, 190. 190. Clear? Please be careful. Loss from speculative can be adjusted only against income from speculative business. Okay. This one is lapsed. Okay. I will just write into here. Next, loss from let out house property of 1,60,000 related to assessment year 24-25 for which belated return income tax return was filed. Guys, important. This is one of the important adjustment. Yes, first of all. Sir, as they have told, it is related to assessment year 24-25 and belated income tax return was filed. First of all, can we carry forward this loss? Yes. Guys, if the return is not filed within the due date given under section 139 subsection 1, you cannot carry forward the loss. But the exceptions are house property loss and unobserved depreciation. Unobserved depreciation. So this too you can carry forward even if return is not filed within the due date. That means for assessment year 24-25, if you are not filed the return within the due date, still can you carry forward the house property loss? Yes, and it is from let out property. Please be careful. And I want to explain more about this. I will take care of it in the solution. Okay, when we are discussing the solution. Yes, and please check whether anything is related to assessment year 24-25. Any of the other losses. Because if it is any other loss other than house property and unobserved depreciation, you cannot carry forward that. Clear? So actually there is no other loss including this relating to assessment year 24-25. Only house property loss. Okay, now so that means can we carry forward this? Yes. Okay. And provided question is silent about it, we are assuming that assessee was following optional scheme in 24-25. Because if he is following default scheme in 24-25, house property loss cannot be carried forward. Cannot be carried forward. So question is silent about it. You can just give a note telling or assuming, sir, he was following optional scheme in 24-25. Got it? Yes. Only then we can carry forward this and adjust it. If you assume that he was following default scheme, then you cannot carry forward this. You cannot adjust it, guys. Got it? Yes. So loss from business specified under section 35 AD pertaining to assessment year 23-24, 4,50,000. Loss from specified can be adjusted only against income from specified business and you can carry forward it for indefinite period. Okay, 4,50,000. Income from specified is there, huh? Income from specified business. Speculative is there. Here it is there. 6,50,000. So against 6,50,000, can we adjust 4,50,000? Yes, sir. We can adjust it. Okay, fine. We'll go to the solution. Computation of gross total income of Navyam for assessment year 26-27 as per the default tax regime under the Income Tax Act 1961. Income from house property, rental income is there 2,52,000. Please be careful. Obviously, it will be from let out property. Yes. Then they are shown that loss of self-occupied property is there in the current year. Can we have loss under the self-occupied property as per default regime? No, not allowed. So this cannot happen. Okay. Then this is the most important adjustment. Less set off of brought forward loss from let out house property of assessment year 24-25 is allowed even if belated income tax return was filed since 8 years period has not lapsed. So as per ICAI suggested answers, they are adjusting it. 1,60,000. But I just want to give few insights here, guys. Very important. Please pay attention now. See, in assessment year 24-25, if this assessee was following default regime, then can he carry forward this loss? No, he cannot carry forward. Because under default regime, you cannot carry forward your house property loss. Yes, sir. Maximum is you can adjust it only within the same age in the current year. That's all. Okay. Now what ICAI has done is, assuming they have followed optional scheme in 24-25, they have adjusted this loss. That too, as it is a let out property. As it is a let out property. So as per this treatment, Sir, what is the treatment of house property loss, or what is the conclusion with respect to house property loss? I will tell you guys, please pay attention here. See, under default regime I am talking about, okay? Under default regime, interest on self occupied house property is not allowed. Even 2 lakh is not allowed, correct? Whereas for let out property and deemed to be let out property, whatever might be the amount of interest without any limit allowed. Yes. Then coming to loss treatment, if you have current year house property loss and if you are following default regime, you can adjust it only within the same head. Only within the same head. Sir, can I adjust it against other heads of income? No, not allowed. Under default regime, not allowed. Whereas under optional scheme, you can adjust up to 2 lakh. Okay, sir. Sir, can I carry forward it, sir? No, not allowed. So if you are under a default regime and if you have a house property loss, it can only be from let out or deemed to be let out property, because you cannot have loss from self-occupied property under default regime because interest is not allowed. Yes, sir. So if you have a loss from let out or deemed to be let out property in the current year, you can adjust it only within the same head. You cannot adjust it against other heads. You cannot carry forward it. Okay, sir. Sir, what about brought forward loss? In this question, this point was with respect to brought forward loss. Guys, see, when they are not allowing you to carry forward the loss under the head house property to next year, obviously, common sense. Sir, can they allow you to brought forward, to adjust the brought forward loss? It should not be. It should not be. But as per this treatment, that is as per ICAI, if the brought forward house property loss is from let out house property, they're allowing to adjust within the same head. Within the same head only. Sir, what if it is a loss from, brought forward loss from self-occupied property? Guys, if it is a loss from self-occupied property, obviously it will be because of interest. Yes. But interest is not allowed under default regime. Yes. But in the past, assume assessee was following optional scheme. He claimed interest for self-occupied property. He has a loss. Can he bring it and adjust it in the current year? No. In the current year, if he is under default regime, he cannot brought forward the house property loss from self-occupied and he cannot adjust it. But if it is a let out, can we adjust? Yes, but only within the same head. Only within the same head. Sir, what if in case? This is what the answer given here. Yes, but I will just go one step ahead and tell. Sir, what if in case in the current year he didn't have any income from house property? He didn't have any income from house property. So he has a brought forward house property loss which is let out from the past year. Now, in the current year, he is not able to adjust it because he doesn't have income from house property. Now, can he carry forward it? No. Under default regime, you cannot carry forward house property loss. Got it? Yes. Hope you understood the point. So, guys, summary. I will just repeat it again. Listen here. Under default regime, house property loss treatment. If you have a current year house property loss, it will be either from let out property or deemed to be let out property. You can adjust it only within the same head without any monetary limit. You cannot adjust it against other rates of income. You cannot carry forward it. Okay, sir. But if you have a brought forward house property loss from let out property, and in the past, the year in which you have suffered the loss, if you were following optional scheme, you would have carry forward it. In the current year, if you are under a default regime, you can adjust that brought forward house property loss only if it is from let out property. Only if it is from let out property or deemed to be let out property. Hope you got it. Yes, sir. Next, PGBP. Profits and gains of business or profession. Profits from chemical dealership business 2,73,000. Profit from business specified under section 35 AD 6,50,000. Current year incomes. Yes, sir. Then we have a set brought forward loss from happy stay business. As it is within 8 years, we can adjust it. 2,10,000. 2,10,000. Yes, sir. Then brought forward loss 35 AD. Specified business. And moreover, please be careful. Here, assessee is doing a specified business under section 35 AD. 35 AD. But we have assumed that he is not claimed any deduction under section 35 AD for capital expenditure other than land, goodwill, and financial instruments. Because under section 35 AD, if assessee is following default regime, then the deduction for capital expenditure is blocked under default regime. Correct? Yes. Sir, they have given some brought forward loss from specified business. Guys, listen here. if there is a loss from specified business, it can be adjusted only against income from specified business. But if assessee is following default scheme, sir, can we adjust the brought forward loss from specified business? No, you cannot. If it is due to the capital expenditure claimed under section 35AD, means if that specified business loss is due to the capital expenditure claimed under section 35AD, then you cannot adjust such loss. You cannot adjust such loss. Sir, what if the loss from specified business is not due to capital expenditure deduction? It is because in the business we have suffered loss, huge loss in business. In that case, can we adjust that loss? Yes. Listen. I will repeat this point again. Again, a key point, guys. Under default regime, capital expenditure on specified business other than land, goodwill, and financial instrument is not allowed. Okay, sir. And as per the loss treatment, if you have a loss from specified business, it can be adjusted only against income from specified business and you can carry forward it for any number of years. But if you have a loss from specified business due to the capital expenditure deduction claimed under section 35AD, assume the assessee was following optional scheme in the past. He has claimed capital expenditure deduction under section 35AD for his specified business. So he has a loss. Now, in the current year, can he brought forward that and adjust it? No. Under default regime, it is not allowed. Under default regime, it is not allowed. Because your capital expenditure is blocked under section 35AD. Same way, if you have a loss from specified business due to capital expenditure which you have suffered in the if you have suffered in the past, even though in that year you were following optional scheme, still in the current year you cannot adjust it. Now the other perspective. What is it, sir? If we assume that this loss from specified business is not due to the deduction claimed under section 35AD, can we bring it in the current year and adjust it? Yes. But if question is silent, what should we do, sir? Don't allow it. Means the brought forward loss from specified business, don't adjust it, guys. Even though we have a current year income from specified business, still don't adjust it. Hope you understood. Yes, sir. Set off of brought forward loss from business specified under section 35AD of assessment year 23-24 is not allowed under default tax regime. See, in 23-24, if he was following optional scheme, he would have claimed it. But in the current year, as he is under default regime, can he adjust it? No, he cannot. Got it? Yes. But they have also given the other perspective, which I told you. If we assume that loss is not due to capital expenditure, can we adjust it, sir? Yes. If it is due to operational inefficiency, we have suffered a loss, then you can carry forward, you can adjust it against income from specified business. Hope you understood. That is what the notice gives. Okay. Then unobserved depreciation, we are adjusting 6,80,000. Remaining business income is 33,000. Okay, sir. Then income from speculative business is 1,90,000. So set off of loss from speculative business of assessment year 2021, 4 years period is lapsed. So we cannot adjust. Then set off of brought forward loss from speculative business of assessment year 22-23. Our assessment year is the last year. That is the 4th year. So adjust it. Adjust it. Remaining 30,000, take it to the outer column. Next, income from other sources, gross dividend from Indian company 147. Then for the award won by the minor daughter, as she has won it because of her efforts, then no clubbing. So nothing is taxable in the hands of father, guys. So gross total income is 3,02,000. Then they have also asked us to give the list of the losses which can be carried forward to the next year. Loss from business specified under section 35AD. Can we see, first of all, we couldn't adjust it. Sir, as we couldn't adjust it, can we carry forward it? No. As the assessee is under default regime, he cannot adjust also. He cannot carry forward also. Alternate view is given here. And if alternate view is followed, then accordingly the income will change. I will just read out that. Alternatively, if it is assumed that the loss from specified business under section 35AD for assessment year 23-24 is not on account of deduction under section 35AD, means if you assume that it is not due to capital expenditure, it is due to operational inefficiency, then Such loss would also stand fully adjusted against the profit from the other specified business, and consequently the carry forward loss would be nil. Okay, now so nothing will be here because we will adjust it fully. In that case, the remaining unabsorbed depreciation for assessment year 23-24 amounting to 1,48,000. How do we get 1,48,000? 6,80,000 unabsorbed depreciation, 5,32,000 remaining income. 5,32,000, how do we get it, sir? I will just show you. Year 92,000 plus 923 minus 2,10,000 you do. Okay, that is before adjusting unabsorbed depreciation. Okay, plus this 30,000 plus 147. This is called remaining income. Got it? Yes. So remaining income will be only 5,32,000. Correct? Yes, sir. So in that case, the remaining unobserved depreciation for assessment year amounting to 1,48,000 shall be carried forward for the indefinite period because we don't have sufficient income to adjust it. So I can carry forward it for any number of years, guys. Yes, hope you understood. This 5,32,000 is nothing but our other incomes. Other incomes is, for example, I repeat again, 92 plus year after adjusting 210, how much is left? You need to check. Take that also. Then don't take this 33. Okay. Then 30 plus 147. Okay. Yes. Next, loss from betting, you cannot adjust also, you cannot carry forward also. Then loss on maintenance of race sources, you can carry forward for next 4 years. And it can be adjusted only against the same nature of income. Got it? Yes, sir. Chill. We'll move forward. One of the challenging question that to ask for 4 marks. If I was a student in the exam who is writing for May 2026, I would take this as an optional question, guys. Especially this 4 marks question. Whereas the other part is easy, B and all. Mention the due date time limit up to which the action can be taken in the following cases as per the relevant provisions of the Income Tax Act 1961. What is it? Filing of updated return of income as per subsection 8A of section 139 in case of partnership firm within 48 months from the end of assessment year, guys. So it is a part of assessment procedure chapter. You can come to that. Yes. You can see updated return is allowed to be filed within 48 months from the end of relevant assessment year. Yes, so first part, 48 months. Next, income tax return under section 139 subsection 1 in respect of non-working partner of a firm whose accounts are required to be audited under the provisions of Income Tax Act. Yes. So this is the due date as per section 139 subsection 1, guys. Just a minute. Non-working partner but subject to tax audit. Yes. Yeah. Due date to file return of income. So you can see anyone who is subject to tax audit as per section 44AB, whether he is a working partner or anyone else. See, company always 31st October, whereas a person other than company whose accounts are required to be audited as per section 44AB, always 31st October. Sir, is a non-working partner. No matter, no problem. Is he subject to tax audit? Yes. So it is 31st October. 31st October. Next, third. Filing revised return under section 139(5) in case of Indian company. So what is the time limit to file revised return, guys? On or before the completion of assessment or 3 months prior to the end of assessment year. That is 31st December of the assessment year. Correct? Revised return, right? Just a minute. I will open it. Yeah. So before 3 months prior to the end of relevant assessment year. So normally the end of assessment year is 31st March 27 for us. So 3 months before that means 31st December 2026. Okay. Or before the completion of assessment, whichever is earlier. This is the time limit to file revised return. Okay. Yes. Next. Applying for the permanent account number in respect of resident individual if his total income during the financial year 25-26 exceeded the maximum amount which is not chargeable to income tax. Maximum amount not chargeable to income tax is nothing but basic exemption limit, guys. So this is on section 139A PAN. 1 second. I will just open it. Yeah. PAN provisions is given here. So if his total income assessable during the previous year exceeds the maximum amount, which is not chargeable to tax, which is nothing but basic exemption limit, within what time they have to make an application for PAN, guys? On or before 31st May of the assessment year. On or before 31st May of the assessment year. So entire question was on assessment procedure. Then alternate question for B. In the following independent cases, state whether the assessee is required to file an income tax return for assessment year 26-27. Give reasons in support of your answer. Even this is on assessment procedure only. Mr. Dhruv, aged 62 years, senior, having interest from FD amounting to 2,70,000. The TDS deducted, so 2,50,000, guys, please be careful. He has interest FD, interest on FD, which is 2,70,000, which is less than basic exemption limit. Less than basic exemption limit. Because see, you can see here, assuming he has opted out of default tax regime, that means he is following optional scheme. Under optional scheme, for a resident senior citizen, what is the basic exemption limit, guys? BEL is 3 lakh. And income year, interest income is less than 3 lakh. So as his income is less than basic exemption limit, not covered for returns. The TDS deducted on his fixed deposit interest by the bank amounts to 26,000. Okay. No other tax was deducted or collected at source. He also made a cash deposit of 10 lakh in his savings bank account, but the total deposit in his savings bank account, including the cash deposit and other credits, aggregated to 48 lakh during the year. So now we are supposed to tell whether Mr. Dhruv is supposed to file the returns or not. Come on, guys. So who should file the income tax return is given in section 139 subsection 1, read with proviso. Yes. So first of all, sir, his income is less than basic exemption limit. Yes. So is not covered in this point. And there is no information given with respect to other points. So we will ignore it. Then come to you. So he is a resident individual who is aged more than 60 years. So TDS plus TCS, only if it is more than or equal to 50,000 is supposed to file the income tax returns. But here it is how much? Only 26,000. So less than 50. So here also not covered. Guys, please be careful. If by chance, if you take this category, you will tell more than 25,000. Yes, return filing is mandatory. No, he is a resident senior citizen. So 50,000 is the limit, not 25. Okay, let us check this point. A person having savings bank account. Okay, the deposit in one or more savings bank account of the person in aggregate is more than or equal to 50 lakh. But in this case, it is 48 lakh, less than 50 lakh. So all 3 points is not covered. Income is less than basic exemption limit. Yes. And TDS is less than 50,000. Yes. And the total deposit into savings account is less than 50 lakh. So return filing is not mandatory for him. Sir, can you voluntarily file it? Yes. So we'll just see the answer. Just a minute. So you can see here, not required to file the return of income because his total income is less than basic exemption limit and TDS is less than 50,000 and the total deposit into the savings account is less than 50 lakh. So no return filing. Sir, can he file voluntarily? Yes, but not mandatory for him. But not mandatory, guys. Yes, sir. Fine. We'll go to the second case. Dr. Nirav, aged 50 years, he is a renowned art surgeon practicing as a sole proprietor. His gross receipts from the medical profession during the year was 10,50,000 receipts from profession. After deducting allowable business expenditure of 8,10,000, his net profit is 2,40,000. We can consider it as income. During the year, he has earned 10,000 as interest from savings bank account. Assuming he has opted for default tax regime. So he's following default scheme, guys. Okay. So receipts from profession is more than 10 lakh, guys. So return filing is mandatory. Irrespective of his income, if a person carrying on a profession, if his gross receipts during the year is more than 10 lakh, then return filing is mandatory. Sir, his income is less than basic essential limit because under default scheme, basic essential limit is 4 lakh. So if you consider his income, it is 2,40,000 and even if you take 10,000 interest, it is only 250, sir. No problem. He might have not been covered here. He is not covered here. Okay. But is covered in this provision. So you can see as per rule, is he supposed to file income tax return? Yes, guys, he should file. Let us see the answer. Required to file his return of income as the gross receipt from profession is 10 lakh 50,000, more than 10 lakh, return filing is mandatory. Even though his income is less than basic essential limit, he should still file the income tax returns, guys. Yes, so this is all about the discussion of income tax part of May 2026 question paper, guys.